Hello and welcome back to our Business Tips. Michael Lapede here in a small mini-series talking about maximizing the use of your family trust. And this video we're going to talk about some key tax considerations with your family trust. The first thing that you need to know is for income left inside the trust. We've been talking about flowing income through, retaining the same characteristics, but what if you wanted to leave assets and money in there, or money to acquire assets in there? Now, trusts will pay tax, and typically it will pay at the highest personal marginal tax rate, so keep that in mind when you're planning. The trust will pay tax at the highest tax rates when it's a family trust. Now, this is different for testamentary trust. When people pass away, there's great graduated rate trusts, but this is specifically for a family trust. You will pay tax on that income at the highest rate. Now, trusts can also have deductions and credits, so like an individual, so things like dividend tax credits, capital gains, cut in half, donations, etc. There's a number of tax credits and deductions that a trust can claim. Not as many as an individual, but there's still a number one, so you got to make sure that you're claiming all deductions and credits. And typically, because of that high tax in the trust, you're going to want to plan around that high tax. And a lot of times you would retain income in the trust if there's a purpose for it, or if you're already in the highest tax brackets personally, you don't want to take the income personally and it doesn't matter, you might as well tax it in the trust at the same rate, and then it can be distributed as capital later or can be invested from the trust, right? So typically we want to use trusts for holding assets and distributing cash flow versus holding on to cash itself. In most cases, losses cannot be flowed through like income and gains, right? So we don't flow through a loss like a flow-through share or a partnership. The loss is maintained by the trust and can be carried forward to future years against gains in most cases, okay? Now, we also want to consider discussion of paid or payable allocations and the idea that allocations to adult children can be non-cash. For example, we can say, hey, payable to you of a dividend of $50,000. We're not giving it to you yet, but it's payable on the books. We say in the trust it's distributed even though it hasn't been distributed yet. It's okay to have a payable. Or maybe, for example, there could be other assets that we want to allocate in lieu of the cash, or just period give the assets to a beneficiary, and we're allowed to do that. And that's treated as very similar to income. If it's after tax, it's taxable as that type of income. Now, another thing to consider in the tax rules is there's a 21-year deemed disposition rule on trusts, particularly the family trust is one of them. And after 21 years, whatever assets that are in the trust, we got to look at what gains would be on those assets and either A, distribute them, B, say we are gonna distribute to these beneficiaries in the future, or C, pay the tax and keep them in the trust. The trust still keeps going after 21 years. It's just called a deemed disposition. It's actually the exact same thing when you pass away. There's a deemed disposition on all your assets the day you pass away. It's like you sold everything that day, right? And they tax you on all of it at one shot. So planning in advance is the key to success in that area, of course, right? Now, providing the trust as property, it can do what it likes, obviously, with that property as long as it's within reason, because the idea is that the trustee is managing the trust property on behalf of the beneficiaries. But at the end of the day, we got to make sure who those beneficiaries are. Now, if the beneficiaries are local, and we're talking in Canada here, and they're Canadian, they have specific rules and they're very straightforward. But as soon as you have a foreign non-resident beneficiary, there's other rules and foreign reporting and foreign withholdings that you must do if you want to distribute to foreigners. Now, there are lots of other complicated measures within trusts, of course. This is a very short series with a very short summary, but some great nuggets for you. I'm sure you'll have many more questions on this, and we'll do more videos later. But don't hesitate to contact us and ask questions. Thanks for being a part of our business tips, and we'll see you looking in the next video.